Weekly Market View. I'm back with Bill this week. So I think the event of the week so far has been obviously the Fed minutes that we saw last night, and then we had Bernanke talking following it, but after the markets had closed. They obviously said they were going to keep accommodative monetary policy for the foreseeable future. What sort of effect did you see, or did we see in the markets?
Well, I think the most dramatic effect we saw, as you said, it was after everybody closed except for Asia. We saw a massive move down in the dollar. I mean, between this time last week and now, at one point we had over a 6-point up and down move with the euro, and almost a 7-point move with sterling. And I think that's what we saw, because last week the dollar bears, if you will, got totally caught off guard by the comments both from the ECB and the Bank of England, and hence the reason they were expecting. And I mean, we went into the weekend with everybody talking about it was called tapering.
Yeah.
You know, the Fed would announce formally at the September meeting, you know, the reduction of the tapering back. And I think yesterday the market really got caught. It's hard to say flat-footed, but I guess it goes back, and this is well before you were born. Twice a year the Federal Reserve has to go before Congress to justify their position, as all agencies do. And this is back when Greenspan was chairman. It was probably, say, the late 90s. And one of the senators asked him a question about this, that, or the other. And Mr. Greenspan's comment was, if you understood what I said, you must not have been listening. And I think basically what Bernanke said last night was, you probably weren't listening from what the minutes said versus what I said. And even yesterday when we got the minutes, it did show a division within the FOMC. And I think one of the classics, this is my history buff coming out. Janet Yellen, who's now the co-chairperson, is probably designated, if Bernanke decides not to roll over his contract next January. Well, her husband won the Nobel Prize in Economics in 2001. And this goes back to the September 1996 meeting of what his premise was. And she expounded on it then, basically saying that the inflation rate and the unemployment rate move in inverse directions, meaning if inflation is too low, the unemployment rate will be either high or higher, because you're not going to hire people if you're not concerned. And of course what we've seen is the unemployment rate is still struggling at 7.5, and yet we've got an inflation rate that continues to go down. So if anything, people would have remembered, or should have remembered, if they're old as me, what she said in '96 and what was reiterated, and how her feelings been. So in reality, the premise was there for what happened last night, and as even the minutes said, well, we're struggling with bringing the unemployment rate down, and inflation is not a problem. And as we saw, I think volumes in Asia, were equity volumes were like 35% above normal overnight. Everybody buying stocks. Even the bond markets moved. Gold's up 35 bucks or something. The only thing that's been hammered today has been the dollar.
Yeah, I've got the impression that Bernanke sort of thought the markets had overreacted before, and he was trying to correct that move. So do you think that he sort of had that desired effect today?
Well, they're not supposed to. Okay, the central banks are not supposed to manipulate the markets. I think one of the interesting things is, did the Bank of England and the European Central Bank last week really totally explain, maybe too much so, that interest rates will be lower for longer here, both in the UK and the Eurozone, where, maybe if people had looked at the minutes more closely and not maybe misread or misheard or misunderstood what Bernanke said in his latest press conference after last month's meeting. But I mean, I think at one point, there was even talk of maybe they start tapering at this meeting, which is the end of July, and then it was September. I think now probably we're talking about well into 2014. And
I think to start the tapering 2014?
Yes, because I do expect a new governor to take effect on the 1st of February. It would be rather silly. It would be sort of like Mervyn King, or Sir Mervyn, doing something in his last month or so before he gave the reins to Mark Carney.
You touched on the ECB. We saw quite an interesting statement from Draghi last week, where he did give some more formal guidance from the ECB. He tried to keep it rather loose, lower or present rates for a longer period, but no specifics. What do you sort of expect from the ECB? Because we obviously had Asmussen out saying, making the comment that it's longer than 12 months. Yes. They tried to backtrack on that a little bit.
Well, I think one of the things, and over the weekend, Der Spiegel, one of the German papers, basically said that they had gone into last month's meeting with basically one of the council members already having written up the proposal for a 25 basis point rate cut, of which Draghi did support. And then they say 7 unknown northern delegates voted against it. So again, it was quite interesting because, again, in the press conference, he said that the decision to keep rates on hold was unanimous, but it wasn't unanimous according to Der Spiegel going into the meeting last week.
There was always a bit of confusion there. Do you think that they're obviously trying to achieve a bit more stability with this forward guidance? Do you think they're going to get that, or do you think with these comments thrown back and forth,
I really don't know. And I think this goes back 3.5 years ago, you know, when we were first having this slight problem with Greece, and Angela Merkel said before the German, whether it's the Bundesrat or the Bundestag or whatever, she said, politicians should stay out of financial markets. We do not understand them. But yet, this is what we're having right now. Central banks basically playing trader, if you will, rather than looking at the big picture.
Yeah. Also, you touched on the UK and obviously Carney and his surprise statement last week. We've seen some, after seeing sort of stronger PMIs from the UK, we saw some quite weak data at the start of the week in terms of manufacturing production and industrial production. We then had a 0.6% estimate from the NIESR for sort of Q2 GDP. How do you see Q2 GDP coming out? Do you think those PMIs will sort of keep it stronger, or do you think it's manufacturing?
I think yes, and also, I guess maybe it's me. I have a trader's mentality. GDP is last week, last month, last year. And I remember, you know, years ago when I was at Bloomberg, having a discussion with somebody who was talking about, you know, we got a GDP number, and I made a comment about whether it's good or bad. You know, and off camera we were talking about it. I said, well, as a trader, I've got 15, maybe 30 seconds to decide whether a statistic is market positive or market negative. You as economists have 3 months to evaluate, reevaluate, and then reevaluate again the GDP numbers. And I think one of the things that, you know, if you see with the GDP numbers, on a regular basis, you adjust what some of the output is, okay? I mean, you know, 20 years ago, if you looked at GDP, did it put down computers, you know, iPads and stuff like that? And so you have to keep changing what's important and what isn't, okay? And I think that's one of the things to look at. But one of the things also, with sterling at 154, 155, it's going to be an extreme negative in reference to exports. So the ECB has got to be far more pleased with the euro struggling now at 130, and we were at 128 below. Yeah. You know, I mean, we saw back in 1st of February it was 137. Well, this will kill any export market, and we've seen the slowdown in Germany, okay, because of the strong euro.
Yeah. We've also China as well this week, a bit of weaker import and export data. We're looking, and they also had inflation data coming in much stronger than they expected. They were expecting a fall of 2.7, we got positive. That's still below their target of the 3.5% inflation that they're heading for. There have also been some chatter around sort of the reserve ratio requirement being cut. Do you think that this is something China would do? I know that they sort of changed it last year in order to try and encourage lending, and now...
The dichotomy you've got with China is, or with any central bank, they have to look at the domestic economy, okay? It's all very good looking at the global economy, but you know, whether it was India in adjusting ratios on gold because it was having a negative inflation effect to them, or China doing something like this. But I mean, one of the things is that we are seeing a dramatic change, okay, in China in the global economy. I mean, I just remember going to China. This would have been the year before, okay. China gave, you know, or the UK gave independence to Hong Kong. Well, if you tried to cross the street those days, there was 60 billion push bikes in one motor car. Well, I think if you go to China now and you go to their equivalent of the British Museum, they'll have a bicycle in there, and the young kids will say, "What is that, Granddad?" Yeah. You know, what is that? As everybody has a car. And I think you're seeing that now in reference to technology. Even their eating habits, okay, are changing dramatically. So you're seeing a shift in what the Chinese, the old timers would have looked at as what was important in their economy, whether it be growing weed or this, that, or the other. This is all changing dramatically. And it will have, if you want to call it, a negative effect on their GDP numbers.
Yeah.
But remember, I don't think this country would be, if our GDP was downgraded to only 7.5%, oh my goodness, we won't get 7.5% like in 5 years combined.
There's quite concern that they might fall below that sort of 7% threshold. I think that's when China would start to maybe look at stimulating. I think they want to keep it above 7, because it's been above that level for I think 23 years or so.
Yes.
So obviously it would be quite a shock for them to come down. Do you see that? Do you see that much weakness in China, or do you think they'll hold?
I don't. Because one of the things is right or wrong, China can do internal stimulation however they want to, okay? And maybe this should be said on television or whatever. They can manipulate the numbers, they can sort of cross out one of these. And again, you see, if you can always change this in reference to the base effects. And we saw this with the GDP numbers. Well, how much was affected by the weather? How much was affected? Like here, we're sitting in glorious sunshine. Yeah. But 2 weeks ago, if you went to the high street, everybody was having, post-summer sales, because everybody was still buying winter clothing, and nobody's bought a bathing costume yet. What are we going to do with it?
The last story I wanted to touch on from the week is the downgrade of Italy. It was downgraded to match other ratings, so not too dramatic. But we've seen, weaker auction today from Italy. They've got a really high debt to GDP ratio. It's really not looking that great in Italy. What do you think they need to do in order to put it back? Do you think it would be something as dramatic as leaving the euro now? Do you think it's gone that far?
Now, if we were to leave the euro, that would be with Greece, okay? They won't leave. They can't leave. And it's also a situation where, maybe they just, if they have a problem, have another 2 glasses of Prosecco. Or I can't say that now. Is that not an EU-approved word? But if you've been to Italy, and if you've been to Spain, it's sort of, manana, it's not a problem. And basically, the rating agencies aren't telling Italy anything that Italy already didn't know. And because the simple fact is, having used to trade Italian bond swaps and Italian bonds themselves, Italy's got the 3rd biggest, bond market in the world, and there was never any problem. And that always helped Italy, because the simple fact is, you try to do a swap in Greece, it could take you 20 years to find the other side of the swap or find enough. And I remember years ago trying to do a swap on Danish mortgage bonds. Well, that was probably 15 years ago. I'm still trying to find the other half of the trade, okay? But with Italy, there was never a problem, and there'd never be a problem with the liquidity. And again, I think with what's happened with the rating agencies, and I'm not trying to be negative, but does anybody trust them? Does anybody really care? The classic for me was in 1974, right? Again, well before you were born. The Dow Jones decided for the first time ever that they would have a bank. And so they decided to go for the Morgan Guaranty Trust Company, which at that time was the best bank in the world. Well, they were going to charge us, $500,000 to look at our books to give us a AAA rating. And we said, well, I can't see this on television, what we said, okay? But and also with Microsoft, right? As Bill Gates says, do I need to pay somebody $500,000 to tell me that I have a terrific company? Yeah. Hence the reason, they were on the S&P for years and years and years before they went to the. So, it's one of these things. They're not telling us anything that we didn't already know about Italy. And will it have a negative effect? No, not really. But one of the things which will help Italy is because what we've had with the Fed, people now, not that we're going to have a bond market rally, but look how the 10 years moved, like 20 basis points, okay? We're 275, we were heading for 3 now. I think the last look was like 256 for the yield on the Treasury 10-year.
We saw also Japan, their buying of foreign bonds went positive again, I think this week.
Yes.
It's been quite a few weeks of negative, that they weren't coming into the markets again, but now they're starting to come back. It'll obviously take a few weeks to take effect, but do you think this will have a positive effect?
Yeah, I think it will. And we'll get this, with the TIX data, okay? But that's always on a 3-month delay. But now, with Treasury 10 years at 2.75, with the base rate not going up probably until early 2015, for a bond yield. But one of the things that's helping, especially the U.S. market, is by the 27th of June, we've had almost $80 billion worth of bond holding redemptions in the money markets, right? Well, now if we know that interest rates are not going to be going up, and you didn't like negative interest rates a month ago, there's a wall of money in the U.S., and I'm sure the same thing would exist here in the UK and probably in the Eurozone, where people had been liquidating. Yeah. So also, you know, and also you follow this more than I did, but I mean, look at the spread between, you know, the Treasury 10-year and the Bund 10-year. I mean,
Yeah.
it was a 7-year historical low.
Okay, brilliant. Well, thanks very much,
Thank
Bill.
you.
Yeah, we'll see